All right, so in this video, I'm going to talk about the risks associated with dying early. And in this case, specifically the financial risks associated with dying early. Because obviously, life insurance doesn't change the probability that you're going to die early. So we are trying to evaluate the financial risks associated with dying early and how that kind of interrelates with age and the phases of your life and so forth. So generally speaking, when you start looking at a person's financial life and kind of what pattern that takes, they're generally considered to be kind of broadly about three general phases of a person's sort of financial life. You have the accumulation, conservation, and distribution phases. So let's talk about those. So accumulation, this is generally going to be from, you graduated from high school and or college. You are now part of the workforce, and basically you start accumulating. And so you are, building up that bank balance a bit. You eventually move into buying a house. You buy a car. You start a family. So basically you're paying off possibly student loans. So the idea is typically in terms of financial situation, what you're doing is you're gradually building something financially. You don't have a whole lot yet necessarily, but you're trying to build towards having more. Eventually, this will sort of segue into conservation, and there isn't like one perfect line where that occurs. There is some overlap here. But eventually, as you get sort of progressively older and you start hitting, say, more your late 40s, early 50s, you're creeping up on 60, what's going to happen is you start shifting into focusing not as much on accumulation of, say, retirement savings and things like that, but you're trying to conserve or preserve the savings that you have, right? So, for instance, from the investing perspective, when you're 20, if you have somewhat more risky portfolio of investments, that can work out. And the reason why that can work out is because you've got a whole bunch of years before you're going to retire. So if the stock market drops by 40% this next year, you've got time. You can wait for it to recover. You're not in a big hurry. Whereas if you had a portfolio that was heavily invested in stocks and you were 1 year out from retirement and that portfolio dropped by 40%, this is like a complete five-alarm fire. I mean, this is an absolutely epic disaster for you and your financial situation. So normally what will happen is as you get progressively closer to retirement, your focus starts shifting from trying to build the wealth to let's conserve and be careful with the wealth that we have so that I make sure that I walk into retirement with adequate financial resources. Then eventually, once you get into retirement, kind of more that phase, then it starts focusing more on distribution. This is where you're planning out how you're going to be distributing those resources that you've accumulated and conserved, and how you're going to use those to pay for retirement, and eventually, perhaps maybe even distribute it to your children, grandchildren, it's charities, etc. So you're kind of more planning for the distribution. Where is all where are these resources going to go? Now, keep those phases in mind, because we're going to kind of circle back around to that here in a second. Now, this sort of is obvious, but it's important to note, on average, mortality risk increases with age. So just statistically speaking, if you are, say, 18 years old, the risk of you dying suddenly is actually relatively low. If you're 30, still pretty low, but it's a little bit higher. If you are 50, it's starting to creep up, right? By the time you are, say, 80, a lot of people have, they die, right? So even if average life expectancy is creeping up, perhaps, by the time you get older and older and older, the probability of you dying in any given year starts getting higher and higher and higher. So as the mortality risk is increasing with age, this means the risk that you would pose to an insurance company is also going to increase with age because you're just flat out more at risk of dying. And once you get past a certain point, if you don't already have a life insurance policy in place, you're going to have a real hard time buying a life insurance policy after a certain age because there's just too high of a probability of death. Doesn't mean it's impossible. We'll talk about some different types of life insurance policies and how it might still be possible. but it does start getting a little bit more tricky. Now, let's kind of tie those life phases, the accumulation, conservation, and distribution, into sort of the risks associated with dying early and how that relates to life insurance and so forth. So life insurance needs ideally, emphasis on ideally decline with age in most cases if adequate saving is occurring. And so basically what's happening here is when you start out and you're, say, 25, if you get married, you got a kid, well, you don't really have any financial resources. And so what's going to happen at that point is you're going to be looking at the dependents that you have and or a spouse, and you're realizing if I died and my surviving family members, they aren't going to benefit from my job, or maybe you were staying at home with the kids, my child care, and so they're going to be more financial expenses, and basically they're going to have a hard time with it. And so oftentimes what's going to happen there is the life insurance need is going to be pretty decent because of the fact that you have very few financial resources available. So generally, during the accumulation phase, life insurance needs are going to be very much dictated by, do I have dependents and or a spouse? And generally speaking, if I start checking those boxes, I've got some dependents and or a spouse, typically my life insurance needs are going to be pretty high because I have no financial resources to leave behind. And so if you review a prior video, one of the prior videos talked about kind of one of the things that is sort of dictating life insurance is, who's left behind, and then not only that, but what are the financial needs of those who are left behind, right? Well, so if you got people you're leaving behind and you really don't have any financial resources you're leaving, and they've got significant financial needs, we're gonna need a lot of life insurance, okay? So for the accumulation phase, typically life insurance needs are dictated by the dependents and or spouse if you have one, and often they're going to be kind of high because you haven't really had time to accumulate much yet. By the time you get to the conservation phase, generally what's happening here is we're moving closer to retirement. We haven't gotten to retirement yet, but we're getting closer. So think late career. So, maybe 50s, something like that. So maybe late 40s, 50s, creeping up in the 60s, things like that. You're transitioning somewhere in there. And basically, if you have been saving, so if your savings rate has been adequate, then what happens at that point is you actually have accumulated a fair amount of retirement resources. So you have money set aside for retirement. So you've been saving and investing and so forth. And you're moving towards being more conservative with what you have accumulated. And so if you died at that point, you would still likely have dependents. So you might still have a couple of kids are in the house, but they probably won't be in the house for too many more years at this point. You also have a spouse still in many cases. But in this context, you also have been saving for a long time. So if you died, yes, there would be perhaps a financial shortfall, but there would also be resources. And so that amount of that financial shortfall is typically smaller. And so oftentimes the life insurance needs are declining during that period. By the time we get to the distribution phase, so you've retired and you're focusing on just using your money, kind of the whole idea was if you were saving properly and investing properly like you should have been for retirement, well, you've retired. So you don't have an income from your job necessarily, unless you're just working on the side. But basically, you hopefully have enough money that you set aside to support your spending and needs in retirement. And so if you die, those resources are still there. And if the resources are still there, then you kind of get to a point where, well, do I need life insurance at this point? Because if I've already accumulated enough money to meet all my needs during my entire retirement, well, if I die, yes, I still may have dependents, and they do have financial needs, but I have enough money to meet all their needs because I was going to be living off this money too. And now there's just one less person living off of the same amount of money. So in that case, by the time you are getting to the distribution phase, typically your life insurance needs are going to be dictated a lot more by what's going on from an estate planning perspective. And basically what that means is you're going to be looking at, all right, I'm trying to pass this money on to kids, grandkids, what have you. And life insurance is really going to be primarily needed if there's some feature of that that's going to make life insurance beneficial. And I mentioned in a prior video an example. If, for instance, you have a ranch and you got a lot of land and you're kind of land rich and cash poor. So you may be on paper be worth, $1 million or a couple $1 million, but in terms of cash, you have very little cash. Well, if you die and you're trying to pass it on to your kids, well, they could conceivably, depending on the size of the ranch you're passing on, and depending on what the estate tax laws are at the time, you could wind up with a situation in which the kids are facing a tax bill. And if they're facing a tax bill, they're inheriting something that's worth a lot, but which doesn't have any cash. And so they may have a hard time paying the tax bill. And in that case, well, maybe life insurance might actually help with that, where it basically provides a cash infusion so that your heirs can handle that situation adequately. So in that case, it's really not so much about preparing financially to provide for your dependents, because you may not really have much for dependents at that point. So the key kind of feature here is, if you've been saving appropriately, what typically will happen is, as you progress through life, your life insurance needs will actually fluctuate. So if you're young and you have no kids, no dependents, no financial obligations, nothing you're trying to leave behind long term, none of those kinds of things, probably don't need any life insurance. Then once you start checking boxes, you get married, you got kids, things like that. Well, now we actually do need life insurance, and we're going to need to leave a pretty fair amount of money behind, because if we die, then we're leaving people behind, and we aren't leaving a lot of financial resources. So in that context, life insurance is going to spike, and it's probably going to be pretty high in terms of needs. By the time you get to the conservation phase, we've already built up some savings, probably still need some life insurance to cover the gaps from a financial needs standpoint. But if I've been saving appropriately, may not need a lot. So the insurance needs are declining. By the time we get to distribution, really it's more like, do I need life insurance for estate planning purposes? Probably don't need it for other purposes, unless you haven't been saving. So if you haven't been saving, and you are still, you're sort of in the life period where you normally would be at the distribution phase, and yet you're still trying to work when you're 85, well, maybe you do need life insurance if you're trying to provide for a disabled spouse, or a spouse who can no longer work, or something of that nature. But generally speaking, the life insurance needs will decline with age typically. All right, well, hopefully that helps. Thank you for watching, and have a great day.